These are unprecedented times that we're living in, and I have to say that get lots of clients who are asking me about mortgage deferrals and how the pandemic has affected them and what they can do to reduce their payments to improve their cash flow, and what does a deferral really do, and how much will it cost them, and what other options they might have. Hi, I'm Stephen Cruz, mortgage broker with Paragon Mortgages and mymortgagebroker.com, and I wanted to talk a little bit today about all those questions. So because it's an unprecedented time, there's two scenarios that people are basically coming under, and most clients that I talk to are coming under, and that is, one, they've been affected, their income has been affected somehow by the pandemic, and the second person, they haven't been affected yet, but they're not sure what's going to happen in the future, and so they want to plan and prepare just in case something happens. So if you've been affected by the pandemic, then you can call your bank and ask them to defer any of your mortgage payments, as well as your other loans and other interest costs on your credit cards, etc. So if you have a number of different credit cards, loans, mortgages, you can ask your bank to defer those. Some lenders are allowing you to do it just online. So you can just go onto your online portal and make some of those deferrals, and then it's done. Typically that's for one month. So if you wanted to defer it for longer than that, then you're gonna have to connect with them after. And it might be a good idea to do the 1 month deferral right now, and then you can call them later, maybe a week or two later. Right now, lenders are fielding lots of calls, and it's really hard to get through on the phone. What I'm typically recommending clients do is call very early in the morning, so as soon as they open, or call later in the evening, close to when they're closing, so that you can potentially get through when there's lower call volumes. And I'm going to talk a little bit of mortgage deferral and how it works in a minute. What I'd like to do is going to give you a scenario based upon mortgage payment of, say, $1,750. So if you have a $1,750 payment and let's say $1,000 of his interest, then how does that work, and how do the deferrals work? So let me share my screen right now, and we're going to go through that scenario and how it works, so that you know exactly what you're going to be getting into. Okay, here's my screen. So let's assume an interest rate of 3.5% and mortgage payments of $1,700. So $1,000 of that is interest. So a very basic way of looking at this is, if you defer this $1,000 of interest, then that's going to be tacked onto your mortgage, and every month it's going to accrue interest until it's paid off. So as you can see here, every single month the interest accrues on that $1,000, because you haven't made that payment, and it's on top. And at the end of 25 years, then it's looks like $2,500. Now that's kind of a basic, simplistic way to look at it. It's a little bit more complicated than that, because when you tack on the $1,000, then the next payment, to keep it in the same amortization, it actually has to be a little bit bigger. So let me just look at another scenario where we compare a mortgage payments over 25 years and deferring things. So let's just look at that. Okay, so this is a mortgage, say, for $350,000. Payments are close to $1,750. The principal portion on the very first payment, $735. Interest portion is $1,000. At the end of, so from month 0, when you get the mortgage, at the end of the month, you're gonna make the payment at the end of the month, and that will be the balance at the end of the month. And so that next month starts there, and then at the end of the month it goes there. So after 12 months, your payment, your balance, becomes $341,000. So that's a balance once you've made all of your payments. And you can see over time the balance reduces, the interest portion decreases, the principal portion increases. So on this side, it's exactly the same, except you've deferred a payment. So as you can see, you haven't made a payment in the 6th month, which was about $1,000. So this $1,000 is not a principal reduction, but an increase in the principal. And you can see here that the balance has gone up instead of down. So it's gone up here instead of down. So there's a little bit more owing now because you haven't paid off that principal portion that month. So you've kind of you've deferred your mortgage payments by a month, plus you've added on another bit of interest. So there's kind of two components to the whole thing. If we go over time and look down over time, so that's every single month, and then I get up to year 2, and I'm just going year 3, year 4, year 5, just to compare. And at the end of year 25, you can see that there was no balance because you didn't make any deferrals on the left-hand side. Now this one, I'm assuming the interest rate and payments are the same the whole time, whereas on the one, and I'm really assuming that on both, on this side, you can see that it takes longer to do this because that extra principal wasn't paid down and the interest was added on. So it takes you a little extra time to pay it off. So there's 2 more months, or almost 3 payments. So almost 3 payments at the end of 25 years to pay off that $1,000 interest that was tacked on. Now, if we go back and look at it, if you were to increase this payment just a little bit, so let's say you're going to increase the payment. Once you've deferred one payment, you increase it a little bit, and let's say you increase it by $9 a month. Now, instead of making the $1,747 payment every single month for 25 years, you're going to increase it after the deferral by just $9. And let's look and see what that does at the end. And as you can see, then it's very similar. It's actually, you paid it slightly faster, the $66 more you paid by paying $9 a month. Now that's $9 a month over the remaining time, so 24 and a half years. That's quite a long time. If you were to defer, let's go here. If you were to defer 2 payments, so let's say you defer another payment and then another payment. So let's say you deferred 3 payments altogether on your mortgage. Now your mortgage balance is higher again than it would have been, and I'm going to put it back down to 0 so that we can see exactly what this does. So you're keeping the same payments, but you deferred these 3 payments in a row. We scroll down to the bottom at the end of 25 years, and you can see that there's still several payments left over. I can copy this down and just look at this here and see if it goes any further. And it looks like it is several more months. So 3 payments, it's like 6 months extra. 6 to 7 months extra of payments by deferring 3 mortgage payments. Now, let's see, if it was $9 for 1, let's just guess and say $30 for 3 and see if that will help bring it back. And as you can see, it does. It brings it right back. So to keep your amortization the same, what you need to do is increase, or what you'd want to do is increase this payment after you start making them again. So let's just guess at 27 and see how that looks. Yeah, it's very close. So you just have to increase the payment a little bit. So that's how it works. And the longer you wait to increase your payment, the more it's going to cost you over time. If you make some lump sum payments, so if you make a couple of $1,000s over time early, then it won't cost you as much in the future. So this is how your mortgage deferral works. Now let's talk a little bit about other options. And let me just take it out of full screen here. So if you don't want to defer your mortgage payment and you'd rather do some other things, then there's a few options you could have. And if you aren't affected by the pandemic, then most of the lenders will not want to defer your payments, and you'll have to talk to them about that. If you are affected, then definitely they want to help you out. So if you're not affected and you can still afford your payments, there's a few things you can do to make sure that you can afford your payments, or you can ease your cash flow a little bit. So you can certainly look at your expenses and what you're spending your money on, and whether or not you should be spending money on certain things. One thing you could look at is refinancing your current mortgage. So if you have an interest rate that's higher than what's available today, then you could check and see if it's worthwhile to restructure your mortgage, switch it to another lender potentially, or get a lower interest rate to reduce that payment. You could re-amortize it if you have enough equity in your house. If your mortgage is less than 80% of the value, then you could remortgage your house up to 80% max, and do it over 30 years instead of 25 or 20. So that'll bring your payments down as well for the short term. It could help you out. Another thing you could do is look at a home equity line of credit. So again, if you have enough equity, you can finance a home equity line of credit potentially behind your existing mortgage up to 80% of the value. And then you can have access to that money in the future if you need to. You can also ask your bank to reduce your payments to the minimum if you're making extra payments. Another option is to potentially refinance debt and roll that into your mortgage. So again, if you have enough equity in your house, then you could refinance the debt you have and your mortgage, bring it all into one payment, and then that one payment is going to be substantially less than all the debt payments plus the mortgage payment. And that's something that I've seen clients who've wanted to do. So hopefully this information is helpful to you. If you like this information, please subscribe, press that like button, and that really helps me out. And I like to provide information to Canadians about financing, mortgage financing in general, so that you have the best options and you have the best information to make the choices that's best for your family. Thank you, and until the next time, have a great day.